Observe the foreign exchange market on any given day, and you will see a relentless, high-speed flow of data. Currencies trade in milliseconds, reacting instantly to every geopolitical tremor and economic signal. This chart tracks the month-to-month percentage changes in the dollar-yen exchange rate over several decades. The volatility is extreme. But look at this second line, tracking the ratio of US to Japanese consumer price levels over the same period. It is nearly flat. This divergence exposes a critical macroeconomic constraint. The prices of physical goods, services, and wages are bound by contracts and production schedules. They are sticky, meaning they resist immediate change. Asset prices, like currencies, carry no such physical friction. To accurately value a currency, we cannot look at a single snapshot in time. We have to build a dynamic model that links the short-run rigidity of consumer prices with the long-run flexibility of the market. The catalyst for our model is the central bank. As the sole authority over monetary policy, it controls the nominal money supply. We need to make a strict distinction between the nominal money supply, the raw number of dollars printed by the bank, and the real money supply. The real money supply accounts for actual purchasing power, dividing the nominal supply by the aggregate price level. Looking at this fraction, we can see the immediate impact of sticky prices. Because the aggregate price level in the denominator is frozen in the short run, any central bank increase to the nominal money supply translates directly into a larger real money supply. Opposing this supply is aggregate real money demand, the public's desire to hold liquid cash, which fluctuates based on domestic interest rates and real economic output. To isolate the pure monetary mechanics, we will hold real output constant. This establishes our core mechanism. If the central bank forces new real money into the system while prices and output are completely frozen, the domestic interest rate must bear the entire burden of clearing the market. This graph maps the U.S. money market. The downward sloping curve represents money demand, and the vertical line defines baseline real money supply. The Federal Reserve executes a permanent increase to the nominal money supply, shifting the supply line to the right. At the original interest rate, this sudden expansion creates an immediate surplus of real money balances in the economy. The public reacts to excess liquidity by purchasing interest-bearing assets. This demand drives asset prices up, inversely driving yields down. The domestic interest rate falls until the public is content holding the expanded money supply. A nominal monetary expansion forces the domestic interest rate to drop because sticky prices prevent the broader economy from absorbing the shock. Adding a top channel to our chart, we can map how this domestic rate drop alters international currency valuation. The lower domestic interest rate projects directly upward, reducing the rate of return on dollar deposits. But the interest rate is only half the equation. The foreign exchange market is forward-looking, and investors know this monetary expansion is permanent. Investors anticipate the permanent monetary expansion will eventually devalue the dollar. This expectation makes euro deposits immediately more attractive, shifting the expected euro return curve right. The compromised dollar yield meets this elevated euro yield, causing a sharp initial devaluation of the dollar. The combination of a compromised domestic interest rate and the psychological expectation of future inflation creates a compounding effect, punishing the currency's value instantly. Eventually, time passes. The strict parameters of the short run dissolve, and the prices of goods, services, and wages finally begin to unfreeze. This initiates long-run monetary neutrality. A permanent money supply increase must, given enough time, cause a strictly proportional increase in the aggregate price level. Rising price levels slowly erode the new currency's purchasing power, shrinking the real money supply. The interest rate climbs back to its pre-shock level. The exchange rate recovers along the expected return curve, settling at a new equilibrium between its starting point and initial spike. Long-run money is neutral. The policy permanently altered the absolute price level and nominal exchange rate, but left the real interest rate entirely untouched. This four-panel dashboard tracks the exact chronological path of these variables side by side to reveal the anatomy of the shock. At time zero, the central bank executes a permanent step function increase in the nominal money supply. The interest rate plunges immediately to clear the excess liquidity, followed by a slow, gradual recovery back to baseline. The aggregate price level refuses to move at time zero. It reacts only with a sluggish, delayed climb to its new proportional height. the exchange rate instantaneously spikes, exceeding its ultimate target, before slowly decaying down to its permanently depreciated baseline. This exact geometric profile, where the immediate response to a disturbance is vastly greater than its ultimate long-run response, is called exchange rate overshooting. The dashboard illustrates exactly where the friction lives. Because the goods market is paralyzed by sticky prices, the highly fluid asset market must absorb the entirety of the initial monetary shock. Why must the currency overshoot its target rather than jumping directly to its final destination? The answer lies in the interest parity condition, which demands total equilibrium between domestic and foreign expected returns. During the months or years it takes for the long-run adjustment to complete, the U.S. interest rate sits severely below the euro interest rate. To convince rational investors to hold lower-yielding dollars during this entire recovery phase, they must be mathematically compensated. That compensation comes in the form of an expected appreciation of the dollar against the euro. Looking closely at this decay phase, we see that required expected appreciation. For a currency that just experienced permanent inflation to be expected to appreciate, it must first depreciate well past its true long-run value. Exchange rate overshooting is a functional mathematical mechanism. Fluid asset markets overcompensate to maintain global equilibrium while waiting for sluggish domestic prices to catch up.